Alright, hey guys, Scott here again with a brand new live trading video, and for this one, we're going to focus on two experimental wheel strategy trades that I have on here in this paper money account, and both trades are currently in very bad shape. So in particular for this video, I'm going to run an experiment where I'm going to try two different approaches to save these trades and try and bring them back into profits. Right, so basically, if you also find yourself in a similar situation where you've been trying to sell put options on some stocks, but those stocks have simply plummeted down to earth, then again, this video here should be very helpful for you in giving you some insight into how you can try and save those trades. And then ultimately, with this experiment that I'll be conducting starting today, we're going to see over time and as these trades basically play out, which approach is going to be best when trying to manage and save your wheel strategy trades. Now, briefly here before we get started, if you want the opportunity to receive up to 13 free stocks where each stock could be worth up to $2,000, then make sure you watch until the end of the video. And then also, if you would like to join a very exclusive online community where you can learn how to trade options and my overall custom approach to the markets, then you can now join my options trading Discord. So definitely make sure to check out the description of the video below to learn a lot more about that. And then finally, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1-month free trial. Alright guys, so now we'll dive in here, and first up, we'll take a look at my trade in Alcoa, which is AA. And so as you can see here, if I zoom in a little bit on this chart, like I was explaining earlier, this stock has done nothing but just go straight into the ground. And I believe it was on this day right here with this massive breakdown candle where I entered this trade by selling put options on Alcoa here with the hope, of course, that this stock would find some support and continue to move higher. But obviously here the exact opposite occurred and this stock continued to just move lower and lower. So over the course of the various expiration cycles in this trade, I was trying to continually roll my put options again and again for more and more additional premium. And specifically, my short put strikes were all the way up here at $75 per share. And so of course, now with the stock being down to only $52 per share at the moment, this is a very significant problem. Right? Because basically, if your short put options become so far in the money, then at that point, you will not be able to roll them out any longer for additional premium. You'll have to either do it for a net zero credit or perhaps also pay a debit, and neither case is good. And so that's why for this trade here, the August monthly expiration, which was last Friday, that was the last expiration that I'm going to be holding put option contracts on Alcoa. So basically, I finally took assignment on those puts, and now I'm long 200 shares of the stock because, again, I sold 2 put option contracts. And so now when it comes to the wheel strategy, right, once you take assignment on your short put options, the next step you're supposed to take is to flip and sell covered call options on your long shares of stock. But in this case right here, if the stock price is just so far below your cost basis on the shares, then it's basically going to be impossible to sell covered calls for hardly any premium, at least with strikes at or above your cost basis. And so again, like I was saying, my short put strikes were here at 75, but also this position is the result of rolling these puts many times and collecting a little bit of extra premium each time. And so now, if I bring up the calculator real quick, my total collected credit on this position is $1,160, which if we divide by 2 for both contracts, that means right now my total collected credit per contract is $580. And so this definitely helps in trying to reduce my cost basis on the shares, right? Because even though I technically purchased these shares at a price of $75 per share, my short put strike, but also given that I have collected some nice premium here, then it's basically as if I purchased those shares for a lower price. Specifically, if we divide this by 100 to get it on a per share basis, and then if we subtract 5.8 from 75, so 75 minus 5.8, that means my cost basis on these shares is actually $69.20. And so bottom line, what this means, right, is if I did want to try and sell covered calls on my long shares of stock, then technically speaking, I'm supposed to choose my strikes to be either at or above my cost basis. right? Because otherwise, if I chose a cover call strike below my cost basis, and if the stock did recover and rise above my strike by expiration, and therefore I got assigned on the contract, well, I would sell my shares for an overall net loss, right? Because again, if I basically purchased these shares at a price of 69 bucks and 20 cents per share, and if I had to sell these shares for a price below this point, then of course I would take an overall net loss on the trade. But now the main issue though is if we come to the trade tab real quick here on Alcoa, and as you can see here, I'm looking at the September 16th monthly expiration, 24 days left to go. And taking a look at the calls here, the closest strike to my cost basis would be the 70 strike call option. But unfortunately, as you can see here, the price of this call option is basically almost zero, right? Going in between the bid and the ask here, I could sell these contracts for only about maybe 10 or 12 bucks a piece, and that's it. But ultimately here, as part of this experiment, for this trade at least, that's exactly what I'm going to do. So I'm going to sell these 70 strike call options and collect a very, very small amount of premium. It's better than nothing, of course. And we're going to see if this is the right approach. So basically for this approach, this is very much a waiting game, right? Where we're just going to wait and see if Alcoa here can manage a sizable recovery in the near future and try and collect as much premium as we can along the way. But always ensuring that the call options I'm selling are always either at or above my cost basis. And so of course, by doing that, I'm also ensuring that if Alcoa does actually recover, and if I do perhaps get assigned on my cover call options, that the net effect is I will not lose my shares for an overall net loss. And so real quick here, I'll click on the bid price for these 70 strike call options and bring up a sell order down below. And so as you can see, we're going to sell 2 contracts for the 200 shares of long stock I have now. And we'll see if I can get filled at maybe 10 bucks per contract. So we'll go to confirm and send the order. And there we go, just got filled and price improved to 13. Not too bad. All right, so there we go. That's my Alcoa trade. And then now next up, we'll take a look at FCX. And then we'll also go to the charts real quick here. And there you go. As you can see, a very similar story as with Alcoa. And so again, I believe it was on this day right here with this large breakdown candle where I stepped in and sold 2 put option contracts to play for a bounce with FCX. But ultimately, that definitely did not happen. And in particular, my strikes for these put options were at the 46 strike. And then same exact thing as with Alcoa, right? So for FCX here, the stock now is super far below those put strikes. And so therefore, I could not roll those puts anymore for additional premium. And as a result, as of August expiration last Friday, I took assignment on these shares. And now I'm long 200 shares in total for both of those put options I sold. And so once again, we'll bring back the calculator real quick here and calculate my cost basis. And so at this point in total, I've collected 656 bucks in premium, which if we divide by 2 for both contracts, that gives 328 per contract. And then we'll divide this by 100 to get it on a per share basis. And then finally subtract it from my put strikes of 46, right? So therefore my cost basis on these shares is $42.72. And so now with this in mind, we'll come over to the trade tab here and take a look at the option chain for FCX. And so the call strike that would be closest to either at or above my cost basis would be this one here with the 43 strike. But same thing as with Alcoa, the price of these call options is basically zero. So of course I could try to sell these call options anyway and collect a few bucks, but for this trade, I'm going to go way, way lower and perhaps sell the 35s or maybe the 34s. But to make that decision, we'll come back to the charts real quick and do some basic technical analysis here. And so looking at this chart, I would say there's definitely going to be some overhead resistance right around this price at, call it 34 bucks per share. So actually, let me go ahead and borrow this line and move it. And there we go. So as you can see back over here during this time, this line was acting as a major support level where FCX came down and bounced very nicely off that point, came down again and tried to bounce once more, but ultimately it failed and broke down below. So therefore, that's why I'm thinking this line or this price is now going to act as resistance if FCX can manage its way back up to this price. Right, so basically by the September expiration date, which is only 25 days away, I'm hoping this line here can act as a barrier for that time period. And therefore, if I were to sell perhaps the 34 strike call options, these might still have a good chance of expiring worthless. But now, of course, one question that might come to mind is, what if by the expiration date, FCX is above the call strike here, and therefore I get assigned and have to sell my shares far below my cost basis, and therefore I'll take an overall net loss on the trade. And so what I will do in that case is, if we get close to expiration and it's very much looking like FCX is going to expire above my call strike, then at that point I will roll these calls to the next expiration, which would be October in this case. Right, so basically what that means is I will buy back my existing September call options here, and then I will sell brand new contracts with the same strike or perhaps a different strike in the October cycle. And what you'll see is, if you do that, you will collect more additional premium, and most importantly, you will avoid assignment. But that being said, the major potential pitfall with this approach is if FCX just explodes higher and has a massive recovery, and therefore as long as my call options stay super far in the money, then I'll have to roll these contracts many times to try and collect more premium to eventually make back losses on those call options. And then of course, there's always the possibility that if my call options here get so far in the money, if FCX just increases in price by so much that, just like with put options, I will not be able to roll those calls anymore for additional premium. And therefore, I would be stuck with a position where I would still make back all the losses on my shares of stock just by themselves, but all those gains would be taken away once again by the losses on the covered call options. So that's basically the worst case scenario with this approach, where you're selling covered calls below your cost basis. So ultimately, I'm hoping for a gradual recovery in FCX, because if that happens, then that worst case scenario should not ever occur. Right, so again, with a more gradual recovery, then even if FCX is above my call strike by or near expiration, then I can simply roll those call options again and again, avoid assignment, and collect more and more additional premium until eventually those calls perhaps expire worthless, or I can buy them back and still have an overall net profit on the full position. And so with all that being said, I'm going to click on the bid price here for these 34 strike call options and bring up a sell order down below. Going to sell 2 contracts here. Again, 34 strike call, and I'll try and do so for, let's try $80 per contract. And then we'll go to confirm and send the order. And there we go, just got filled at exactly 80. Awesome. And so there we go. I'm now locked into both of my FCX and Alcoa adjustments here, and we're going to see how this experiment pans out over the course of this year. Right, so is it better to intentionally sell covered calls below your cost basis to try and still collect some decent premium with each expiration, or is it better to sell covered calls still at or above your cost basis? And in a few weeks and months, we're going to find out. And so with that being said here, that's going to do it for this video. But of course, one last thing, as I mentioned, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.